Welcome to today's Explainer. We're jumping right into a really fascinating and honestly deeply relevant topic: the macroeconomic forces shaping the Indian consumer's reality in 2026. If you've been feeling a bit of a pinch in your wallet lately, trust me, you are definitely not alone. We're going to look at the exact data showing how global shifts, historical currency changes, and domestic policies are all colliding right now to create a very specific economic squeeze. I'm incredibly excited to break this down for you, so let's get right into it.
To really grasp the overall economic outlook, we just need to connect the dots. We'll start with the shrinking Indian rupee, look at the heavy cost of fuel, trace inflation's upward spiral, examine real wage stagnation, and then wrap it all up with India's 2026 economic outlook.
Let's kick things off with a number that literally hits home: 245 rupees and 25 paise. Because of a staggering 145.25% cumulative inflation rate over the years, you now need exactly 245 rupees and 25 paise to buy what a crisp 100 rupee note got you back in 2010. Your purchasing power has completely shifted over the last decade and a half. And to understand exactly why your money isn't going as far, we actually need to look at the currency itself.
So, Section 1, the shrinking Indian rupee.
The history of the rupee tells a pretty wild story, actually. Back in 1966, the rupee was formally devalued to 750 against the US dollar, mostly due to extreme economic strain and international pressure. Fast forward to the 1991 market reforms and trade liberalizations, and it dropped to 22.74. By 2021, we were looking at 74.57, and right now in 2026, the rupee is sitting near 88.72 to the dollar. It's been this continuous, multi-decade slide, driven by everything from global crises to domestic trade imbalances. And this continuous slide has a massive, immediate, real-world consequence. For an import-reliant country like India, a weaker currency means paying significantly more for global commodities. And the biggest, absolutely most important commodity of all? Crude oil. Because India relies so heavily on imported oil, a depreciated rupee makes the baseline cost of energy fundamentally more expensive before a single drop of it even reaches Indian shores. All right, let's move to Section 2, the heavy cost of fuel. Now, here's where it gets super interesting. Even when global crude prices have actually dipped, retail fuel in India remains notoriously high. Why? Well, it comes down to a steady mathematical increase in both state and central taxes over the last 2 decades. Back in 2004, state taxes were $8.50 and central taxes were $5 per liter. But by 2024, those numbers had steadily climbed to $14.20 and $11.80, respectively. Both state and central governments levy these taxes, and together they form a huge chunk of the retail selling price. Basically, this keeps your costs stubbornly elevated regardless of what's happening with global oil drops. This compounding effect, a weak rupee plus consistently high taxes, is exactly what pushed petrol over that historic 100 rupees mark for the first time back in 2021. And looking at the 2026 data, those prices are still hovering tightly around 103 rupees in Mumbai and soaring up to 107 in cities like Hyderabad. The relief at the pump has been, well, minimal. And as you might guess, that sets off a massive ripple effect across the rest of the economy.
Which brings us directly to Section 3, inflation's upward spiral. When you break down India's Consumer Price Index, the CPI basket, you notice pretty quickly how heavily weighted it is toward the absolute basics. Food and beverages make up a massive 45.86% of the basket. Fuel directly accounts for another 6.84%. What this means is that India's inflation metric is uniquely, intensely sensitive to everyday essentials. So when fuel gets expensive, transportation and freight costs skyrocket. And that increased cost, it bleeds almost instantly into the price of the food and beverages that make up nearly half of everything consumers are buying.
And the 2026 data completely confirms this pressure cooker environment. According to a report by India Ratings and Research, rising global crude prices are already feeding a massive 36% spike in wholesale crude petroleum inflation. Because of this baseline surge, retail inflation has been edging up, hitting 3.9% in April 2026. And the projections for the upcoming financial year, FY27, show inflation climbing even further to 4.4%. The cost of almost everything is just trending upwards.
So let's look at Section 4, the real wage stagnation. The absolutely crucial point is this. If costs are going up everywhere, are incomes actually keeping pace? Well, the data reveals a real consumer squeeze. Between 2022 and 2025, real wage growth has been shockingly muted. Regular wage earners saw only a 1.2% growth. Casual labor, a mere 0.5%, and the self-employed hovered at just 1.0%. When you compare these tiny fractions of income growth against the rising cumulative inflation numbers we just looked at, you can really see the purchasing power of the average citizen being severely compressed.
To make matters even more complicated, we have to factor in job availability itself. In March 2026, urban unemployment actually rose to 6.8%. This puts immense, compounding pressure on the urban workforce. Keep in mind, nearly 50% of workers in urban areas rely on regular wage employment. So not only are their wages relatively stagnant against inflation, but the overall job market they're operating in is tightening up. Let's wrap this up with Section 5, India's 2026 Economic Outlook. We've seen all the individual pieces, right? Now let's put the puzzle together. Devendra Kumar Pant, the chief economist at INRA, summarizes the danger perfectly. He says low real wage growth poses a risk to consumption and GDP growth in FY27. What this means on a totally practical level is that when everyday consumers are squeezed between the rock of high inflation and the hard place of flat wages, they simply stop buying non-essentials. This drop in everyday spending directly threatens India's private final consumption expenditure, which is a major vital engine for the country's overall GDP growth. So we arrive at this ultimate balancing act. On one side of the scale, we've got aggressively rising costs, driven by a projected 4.4% inflation rate and a massive 36% surge in wholesale crude petroleum prices. On the exact opposite side, we have muted incomes, bottlenecks by 6.8% urban unemployment, and a sluggish 1.2% real wage growth. It is a textbook macroeconomic squeeze playing out in real time right in front of us. Which leaves us with a billion-dollar question. Will the resilient Indian consumer be able to hold the line in 2026? Or will the broader economy truly feel the pinch of this squeeze? It's a fascinating, complex dynamic between global fuel markets, currency strength, and the everyday worker's wallet, and it's something we'll be watching very closely. Thank you so much for joining me for this explainer. Keep learning, keep questioning, and I'll catch you next time.